Most people experience global trade as something abstract, distant, and automatic. Goods appear on shelves, software updates arrive overnight, prices drift upward slowly enough to feel manageable, paychecks clear, retirement accounts fluctuate but remain conceptually intact. From the outside, the system looks like it is still working. Yet at the level where effort is supposed to convert into progress, something has quietly changed. The same professional earning $100,000 today, saving diligently, avoiding obvious financial mistakes, and following conventional advice, often feels less mobile, less secure, and more constrained than someone earning far less a generation earlier. This is not primarily a story about inflation headlines or shipping delays. It is a story about incentives inside global trade slowly decaying, and about what happens when a system stops rewarding coordination, efficiency, and long-term trust. For most of the post-war period, global trade functioned as a machine that converted specialization into rising living standards. Countries focused on what they did best. Firms optimized supply chains across borders. Workers exchanged narrower skills for broader purchasing power. A factory job, an engineering role, or a mid-level management position plugged into a global system that amplified effort. The math was straightforward. If productivity rose by 2% annually and prices stayed relatively stable, real incomes compounded meaningfully over decades. A household saving 10% of income could expect optionality later in life. Trade was not about moral ideals or globalization slogans. It was about margins. Cheaper inputs raised profits. Higher profits funded investment. Investment raised productivity. Productivity supported wages. The loop reinforced itself. That loop depended on incentives that aligned across borders. Governments tolerated trade deficits because growth compensated politically. Corporations invested in long supply chains because reliability outweighed fragility. Workers accepted specialization because purchasing power increased faster than costs. Trust was not perfect, but it was sufficient. Contracts were enforced. Shipping lanes stayed open. Currency systems, while imperfect, remained predictable enough to plan across decades rather than quarters. Global trade worked not because it was fair, but because it paid. Over time, that payoff has eroded, not abruptly, but through accumulated friction. Trade has become less about efficiency and more about resilience, control, and political signaling. Each of those priorities carries a cost. Redundancy replaces optimization. Security premiums replace margin expansion. Domestic production replaces comparative advantage. None of these shifts announce themselves as failures. They are framed as prudence. Yet at the system level, they reduce the surplus that once made everyone feel richer over time. Consider a simple numerical example. A firm sourcing components internationally might once have enjoyed a gross margin of 40%, reinvesting 10% into productivity improvements, and still returning capital to shareholders. As supply chains fragment, that same firm absorbs higher logistics costs, regulatory duplication, and inventory buffers. Gross margins compress to 30%. Investment budgets shrink. Wage growth slows. Prices edge higher to compensate. No single decision looks catastrophic. The aggregate effect is that less value is created per unit of effort. This matters because global trade is not just about goods. It is about the conversion rate between labor and freedom. When trade is expansive and incentives are aligned, 1 hour of work buys increasing optionality over time. When trade fragments, that conversion rate deteriorates. People work the same hours, earn higher nominal incomes, and yet feel stuck. Housing absorbs a larger share of income. Healthcare and education compound faster than wages. Retirement projections require more aggressive assumptions. The system still moves, but it no longer lifts. At the institutional level, this shift creates subtle instability. Governments that once relied on growth to smooth over debt accumulation now face tighter constraints. Trade-generated growth made deficits tolerable. When growth slows structurally, debt servicing competes with social promises. Political interference in trade grows precisely because growth no longer absorbs distributional conflict. Protectionist measures feel necessary to preserve domestic stability, even as they weaken the broader system that once supported that stability. The psychology follows the incentives. When global trade expanded, patience paid. Long-term planning made sense. Education investments produced reliable returns. Today, the same choices feel riskier. A degree financed over 20 years competes with an economy where trade no longer guarantees expanding opportunity. The individual response is not irrational. It is adaptive. People seek leverage, side income, and optionality, not because they are greedy, but because the system offers less margin for error. From a systems perspective, this is classic margin compression. When margins shrink, fragility increases. Small shocks matter more. Optionality disappears faster. Institutions become reactive rather than strategic. Global trade once acted as a buffer, smoothing local inefficiencies through global coordination. As that buffer weakens, volatility shifts inward. Households absorb more risk. Firms shorten planning horizons. Governments intervene more frequently, further distorting incentives. The decline of global trade incentives also changes how time functions economically. Compounding relies on stability. A retirement account earning 6% real over 30 years depends on trade-enabled productivity growth. If real returns fall to 3% because growth slows and inflation drags persist, the outcome is not marginally worse. It is categorically different. A portfolio projected to reach $1 million now reaches $600,000. The gap is not explained by poor behavior, it is explained by systemic slowdown. This erosion rarely feels dramatic. It feels like effort without acceleration, promotions that do not change lifestyle, savings that do not translate into security, businesses that survive but do not scale. Trade fragmentation ensures that inefficiency becomes normalized. Everyone adjusts expectations downward quietly. That quiet adjustment is what makes the system feel stable, even as its foundations weaken. The long-term risk is not collapse in the cinematic sense. It is institutional exhaustion. Systems designed for abundance struggle under scarcity. Trade agreements become political tools rather than economic frameworks. Currency systems bear more strain as trade imbalances persist without growth to offset them. Trust declines incrementally. Each safeguard added to manage risk reduces efficiency further, creating a feedback loop. At the personal level, this explains why traditional financial assumptions no longer hold. The idea that steady effort, prudent saving, and diversified exposure guarantee progress was built on a world where trade expanded opportunity faster than costs. In a fragmented order, those assumptions require revision. Risk-adjusted returns decline not because markets are broken, but because the underlying engine is less powerful. The uncomfortable realization is that this is not a temporary phase. Trade fragmentation reflects structural incentives. Geopolitical competition, demographic shifts, and domestic political constraints make a return to frictionless trade unlikely. Systems adapt to new constraints, but adaptation often means lower average outcomes rather than dramatic failure. The system still functions. It simply converts more effort into maintenance rather than advancement. Understanding this reframes financial identity. Feeling constrained despite doing everything right is not a personal shortcoming. It is a signal that the system's conversion rate has changed. The appropriate response is not panic or withdrawal. It is clarity. Recognizing that global trade no longer reliably amplifies effort allows for more realistic planning. Optionality becomes more valuable than optimization. Resilience matters more than peak efficiency. Time horizons adjust. The slow decline of global trade incentives does not announce an end. It signals a transition to a world where systems absorb more energy just to stay in place. In such a world, the gap between effort and outcome is not a mystery. It is the predictable result of incentives realigning away from cooperation and toward control. The stability visible on the surface is maintained by drawing down surplus beneath it. That surplus once came from trade. As it fades, the quiet strain becomes the defining feature of the economic landscape. At this stage, the more important shift is not what global trade looks like on a map, but how incentives propagate through institutions over time. Systems rarely fail because participants suddenly misunderstand them. They fail because the incentives quietly change while the rules stay the same. Global trade today still uses the language of efficiency, openness, and cooperation, but it increasingly operates on incentives built around insulation, control, and political survivability. That mismatch is where long-term risk accumulates. Incentives determine behavior at the margin. When margins are healthy, systems tolerate inefficiency and still progress. When margins thin, behavior changes even if ideology does not. Firms shorten supply chains not because they have become irrational, but because geopolitical risk has entered the cost structure. Governments subsidize domestic production not because it is cheaper, but because the political cost of dependence has risen. Financial institutions prioritize liquidity and compliance over long-term investment because regulatory risk now competes with market risk. None of this requires a crisis. It only requires enough accumulated friction to change decision-making. To understand why this matters, consider how global trade once converted uncertainty into growth. A multinational firm investing across borders accepted currency risk, legal complexity, and cultural differences because the expected return justified the exposure. If a project yielded a 12% internal rate of return, absorbing 2% of political or logistical risk still made sense. Over time, those investments created dense networks of interdependence. Interdependence reduced the incentive for disruption, reinforcing stability. The system rewarded patience. As trade fragments, that math deteriorates. Political risk premiums rise from 2% to 5 or 6. Compliance costs add another 2. Suddenly, the same project struggles to clear a corporate hurdle rate. Investment slows not because capital disappears, but because risk-adjusted returns no longer compensate for complexity. Capital becomes more selective, shorter term, and defensive. Growth does not vanish, it thins. This thinning has second-order effects that compound slowly. When investment slows, productivity gains decelerate. When productivity decelerates, wage growth disconnects from effort. A professional earning $80,000 might see nominal raises of 3% annually while inflation runs at 4%. On paper, nothing dramatic happens. In reality, purchasing power erodes. Over 20 years, that 1% gap compounds into a meaningful loss of optionality. Retirement calculations that once relied on stable real growth now require higher savings rates just to maintain projections. Institutions respond predictably. Pension systems adjust assumptions quietly, shifting from 7% expected returns to 6%, then 5%. Contributions rise. Benefits stretch further into the future. The system remains solvent on paper, but only by increasing the burden on future contributors. This is not fraud. It is arithmetic under changed trade dynamics. When global efficiency no longer lifts all boats, institutions must reallocate scarcity. Trade fragmentation also alters the distribution of risk. In an integrated system, shocks disperse. A slowdown in one region is offset by growth elsewhere. In a fragmented system, shocks localize and intensify. Supply disruptions translate directly into price volatility. Energy costs fluctuate with political alignment rather than pure supply and demand. Firms hedge more aggressively, passing costs downstream. Households experience this as unpredictability rather than inflation alone. Budgets become harder to plan, long-term commitments feel riskier. Psychologically, this erodes trust in abstractions. People stop believing in averages. The idea that markets trend upward over time feels less convincing when lived experience is flat. This is not because markets cease to function, but because the underlying surplus shrinks. When trade created abundant surplus, volatility was tolerable. When surplus narrows, volatility feels threatening. The same percentage swing carries more emotional weight because margins are thinner. The political response feeds back into the system. As growth loses its ability to pacify distributional conflict, governments intervene more directly. Tariffs, subsidies, capital controls, and industrial policy expand. Each intervention is rational in isolation. Collectively, they further distort trade incentives. Firms allocate resources toward compliance and lobbying rather than innovation. Capital flows toward protected sectors rather than productive ones. Over time, this reduces system-wide efficiency without triggering obvious failure. From a business operations perspective, the analogy is clear. A company with shrinking margins often increases oversight, adds layers of approval, and prioritizes risk management. These actions feel prudent, but they slow decision-making and reduce adaptability. The organization survives longer, but it stops growing. Global trade is undergoing a similar transformation at scale. The system is becoming more controlled, more cautious, and less generative. This has implications for leverage. Leverage amplifies outcomes when growth is robust. When growth slows, leverage amplifies fragility. Highly indebted governments relied on trade-driven growth to stabilize debt-to-GDP ratios. As growth underperforms, debt becomes a structural constraint rather than a cyclical tool. Rollovers replace repayment. Central banks suppress volatility to maintain solvency. Financial repression becomes normalized. Savers bear the cost through lower real returns. For individuals, this explains why traditional markers of success feel hollow. High income without growth is just maintenance. Asset ownership without appreciation is illiquidity. Credentials without mobility become sunk costs. The system still rewards participation, but it no longer rewards loyalty or patience in the same way. Effort converts into stability rather than advancement. That is a profound shift, even if it unfolds quietly. Trade fragmentation also reshapes opportunity cost. In a growing system, delaying consumption to invest makes sense because future returns exceed present sacrifices. In a slower system, the opportunity cost of waiting rises. This does not justify impulsive behavior, but it changes the calculus. The promise that tomorrow will reliably be better than today weakens. Planning horizons compress across society, reinforcing short-termism at the institutional level. Importantly, none of this requires a definitive endpoint. Systems can operate indefinitely in a state of diminished returns, and the risk is not collapse, but stagnation punctuated by localized stress. Trade continues, ships still move, data still flows. Yet the surplus that once smoothed over inefficiencies is gone. The system becomes less forgiving. Errors compound faster. Trust decays incrementally. This is why long-term frameworks matter more than forecasts. The question is not whether trade volumes will rise or fall next quarter. It is whether the incentive structure still rewards coordination over fragmentation. Current conditions suggest otherwise. The benefits of integration accrue slowly and diffusely, while the political costs are immediate and concentrated. That asymmetry favors fragmentation even when it reduces total surplus. Understanding this dynamic allows for clearer interpretation of personal experience. Feeling behind, despite discipline, is not an anomaly. It is consistent with a system that no longer compounds broadly. Recognizing this does not provide easy solutions. It provides realism. In an environment where trade no longer reliably expands opportunity, preserving optionality becomes a central objective. Avoiding irreversible commitments matters more. Flexibility carries a premium. The slow decline of global trade incentives reshapes how societies allocate effort. More energy goes into defense, compliance, and risk mitigation. Less goes into expansion. This is not a moral failure. It is a systemic response to changed incentives. The danger lies in mistaking stability for health. Systems can persist long after their growth engine weakens. What ultimately defines this phase is not crisis, but drag. Inflation that never quite recedes. Growth that never quite accelerates. Institutions that function but do not inspire confidence. Global trade continues to exist, but its role shifts from amplifier to constraint. Effort still matters, but it no longer guarantees momentum. Seeing this clearly is uncomfortable because it challenges deeply held assumptions about progress, yet clarity is preferable to false reassurance. When the system's incentives are understood, the widening gap between effort and outcome becomes legible rather than personal. The future, in this context, is not about predicting recovery or collapse. It is about navigating a world where the conversion rate between work and freedom has structurally changed, and where global trade no longer quietly carries the weight it once did.